Hi folks, Michael here. In this video, we're going to look into some intermediate option trading strategies. So maybe you've gone a little bit further than the beginner strategy. Typically you're looking at covered strategies where you have enough money if you have to buy stocks or indexes off someone, or you have stocks or indexes so that you can sell them or give them away to someone if you're also called upon to do so. So you are totally covered usually. And usually with beginner strategies, we're thinking about directional bets. Either the market's going to go up or the market's going to go down. And usually we're just looking at one option. Either you're buying something or you're selling something, but just one option contract. Now with intermediate strategies, the key difference is that we're thinking about buying or selling two or more options simultaneously. So this is what's known as a multi-leg approach. It also could be the case that you're thinking of making money when the market is neutral or sideways. Now we saw that of course back in 2022, the market was pretty flat for most of the year. We've also seen that in little bits and bobs early in 2025. And as well, we've seen periods where there was more volatility, like higher volatility, let's say during 2020, and also some other periods where the market was relatively smooth or low volatility. So these neutral, like making money in the sideways market, that's great, right? Because if you just have buy and hold and you're just holding stocks or holding indexes and there's not much growth, you can't do much with that, right? Over time, you're not going to make a huge amount just on appreciation alone. So we're going to look at various ways of extracting some extra profit, but a bit more advanced now than the simple strategies. We can also look at range-bound bets. So here we're thinking, well, we think it's going to go up, but only up by a little bit, or it's going to go down, but only down by a little bit, or it's going to be somewhat volatile, right? But it must be at least this volatile. Or we think about the opposite, that it must be at least this calm. In this particular video, we're going to look at vertical spreads, two examples of vertical spreads, as well as joining them in what's known as an iron condor, right? Seems pretty cool, right? Well, we're going to get to that in this video. If you like this video and you think that other people could benefit from it, why not share with them? It only takes a few seconds to like this video. It's totally free, helps the algorithm, and I'd really appreciate it. Definitely encourages me to create more free investing and personal finance videos. So the first vertical spread that we can look at is, for instance, the bull call spread. Now, how this operates is that you buy one call and you sell another at a higher price. So you're buying one call and you're selling another call at a higher price, the same expiry date, same expiration. Now your long call that you're buying offsets the risk from the short call. Because remember, with shorting a call, you have theoretically infinite risk, right? Infinite potential loss. If the stock keeps going up and up and up and you're asked to buy at the new price, that price could theoretically be infinite, unless you have covered it by owning the actual stock or owning the index. But another way you can do it is having bought a call that allows you to buy at a lower price, so that you're limiting that risk should the actual price of the stock go up by a lot. So you're capping your losses here. So looking at one particular example in a plot, the bull call spread payoff at expiration, we're going to have a look at what's happening here. So we're going to short a call at the price around 105, let's just say. Now what this means is, okay, if we just shorted that, we would earn this orange gap between 0 and something positive. We're earning a rent, although we don't necessarily own the stock now. Now we're earning this rent, and that's fine, but once the price starts to go up above that, we can get it exercised. So we may actually have to give the stock to the person or party that bought the option from us, that bought the actual call that we wrote, that we sold. So it could be the case that, sure, we may have to buy it if it's 105 or 106, but look, if the price goes up a lot, right, we're now buying it at a much higher price, and so we really start to get into lost territory. We've earned this small little rent up front by selling the call, which covers us a little bit over the strike, but then we are into this theoretical infinite loss down here. Now on the other side, if we had just longed the call or bought the call option, that's the yellow dotted line here. So we've bought the option to buy, let's say at a price of 95. So we've paid for it here, as we get into the stock, if we buy it at 95 and the stock goes up and up, well, eventually it's going to cover the actual cost of buying the option. And as the stock price goes further up, we're really into positive territory here and making more and more profit. So by both buying the actual call option at a lower strike, let's say 95 in green, and we are selling the call at a higher strike, let's say 105, we're actually limiting our loss, but also limiting our benefit, our profit. So we can see this here, that as the price moves a little bit above 100, we're really in positive territory, even below 100 to be honest. So as the price goes down too much, if the price falls too much, we have limited our loss, okay, because we've earned this rent here between the orange, but we've paid for it down here between the yellow dot and the 0 line. But the earning reduces our loss to this solid line here. If the underlying asset has just fallen in value, if the price has gone way down, at least we're limiting our maximum loss here on the downside. But we're also going to limit our maximum gain on the upside, because theoretically we could have to give someone the stock at a very, very high price. But at least we have that option to buy at 95. We could sell at around about 105. We've earned the rent from selling the call option, but we've also paid a premium to buy that call option at the lower strike price. So the bull call spread limits our downside risk, but it also limits the upside gain potential. And in between, we can see that, well, we can just about break even if the price falls a little bit, but not quite to the lower strike price. As the price of the stock goes up a little bit, we are gaining. And we can do this without even owning the stock, right? And it costs a trivial amount usually to buy these options. We can just buy an option, we can sell another option for a small amount of money, and we're not even having to hold that amount of money in our account or hold the stocks or hold the indexes. We can do it just like this. We can gain a little bit here, and the ideal aspect here is if the price could fall a little bit but not a lot, or ideally the price is around the same or it goes up. If we think it's going to go up by a lot, well, we're just not going to be able to tap into that, but we're locking in a certain amount of gain but limiting it. So that's what's known as a bull call spread. But on the other side, we could have a bear put spread if we are a little bit more pessimistic rather than optimistic. So here we're thinking about buying one put and selling another at a lower strike. Here our long put is going to cover the risk of the short put. And to see that in action, we'll have a look at the following graph. Let's say we bought the put at a higher strike price of, let's say, 110. Now by buying that, we got that yellow dotted line here. So we've bought it, we've paid a price, we've already lost that price. It's locked in, that's the premium we've paid for this insurance, so to speak. But at least we get out at 110. So as the price starts to fall, we could even think about, well, we can sell at 110, even if we don't own the stock, we can buy. Now let's say the stock is at 100, so we can buy at 100, we can sell at 110. You might think that you're profiting 10, but no, we have to reduce that profit from 10 to something less than 10 because we paid the premium originally to buy that put. But at least we are making profit. And that profit does go up if the price of the underlying asset is falling. Because again, we could come in here, we can just buy with the market at this price here, around about 80, and we have the option of selling at 110 because we have bought this put. So that's quite nice if the price goes down a lot. Now, if we also short a put, let's looking at shorting, we're earning a rent, so we're earning the gap between the 0 line and this orange dotted line here. Now, what we're doing, we're earning the money, and the thing is that that's great while the actual price of the stock doesn't fall below the strike price. But once the price falls below the strike price, it could be the case that we have to buy the stocks or the index from the purchaser of the put option that we've written or we've sold. So we may have to make a loss here in this case because we're buying at, let's say, 100, and the price of the asset could be going lower and lower and lower. So we're paying 100 for something that may be losing its value. So we're buying at 100, an asset that is possibly going lower and lower and lower, which is where we're getting our loss. Now, the nice thing about the bear put spread when you put both together is that you're going to be able to limit your downside risk over here on the right. So with a bear put as opposed to a bull call, here we're kind of thinking that we're going to gain when the price of the stock starts to fall, right? So because when the price goes up, well, we've paid for the put, but we've earned the actual from shorting the put. We've earned a little bit, but we've paid a little bit more. And so we have that gap. It's reduced a little bit by the rent that we've earned on selling the put. So the solid line gives us our bear put spread if the price goes up. But where we really kind of benefit is when the price goes down. When the price goes, so it's kind of limited when the price goes up. We're not making a huge amount of loss. We're kind of hoping here that the price, if anything, goes down a little bit. It could go, it could be the case that it's at 105 or a little bit higher, but we're hoping it'll go a little bit lower. Now, the price could go all the way down, and that's great if you were just longing the put, but at least we've limited the loss on the other direction if the price goes up or stays the same. We're making a little bit more relative to the yellow dotted line, provided that the price of the asset doesn't fall a lot. So really where we start to benefit is around about, let's say 106, 107, all the way to about 98, 99. So in this range here, we're thinking about, well, we've bought the actual put, we've sold another put, so we're seeing the difference. And the fact that we can sell at 110 and buy at, let's say, 100 or wherever it is, means we're limiting it. We're getting that gain, right? The gain is going towards 10. Best possible situation here is around about 100, where, okay, we can buy at 110, we can sell at 100, the profit is 10. However, we did have to pay to buy that other put option, although we did sell the other one, so there's a gap there. The net premium is why we're not getting fully 10. That negative net premium that we're seeing here below the zero is the same distance here from 10 down. So we're locking in or limiting the reward if the price does in fact go closer towards zero, but we're also limiting the risk if the market goes the opposite direction. So it's kind of range bound, right? We're really hoping that it's going to fall by a little bit, not a huge amount. So we're really getting with both the bull call spread and the bear put spread, limited risk and limited reward. It is useful in these directional trades to a certain extent, right? We're really capping things, but you can see that we can get into these trades without even owning the stocks or owning the index. And yet, because we've got the puts or the calls, because we've actually bought multiple of these and we've staggered it just correctly, as a result, we can make these trades with less money down and still have locked in that risk control, which is excellent, without exposing too much of our capital. Now, let's combine both into what's known as the Iron Condor. I'm really excited about this one. So this one here, the Iron Condor, this combines two vertical spreads, a call spread and a put spread, just like we've seen individually. Now here the key is that we're going to profit if the stock stays in a certain range. So that's great for sideways action or low volatility markets. Again, this could be 2022 with sideways action. As long as it doesn't jump up or jump down by too much, you don't get too much seesawing, then you can do quite well with an Iron Condor strategy. So let's look into that next. So looking at the Iron Condor, here we're saying that we hope that the market doesn't jump much below 90 and also doesn't jump much above 110. So that's the stock price. So here what we're doing is with the red dotted line on the upside, we're shorting a call. So we're earning a premium from shorting a call. We're paying to long a call. That's the actual green dotted line here. But again, remember with the short call, you start to lose money. Theoretically, it could go infinite loss, because again, the price of the stock is going up and up and up, and you have to purchase it at the current value, but sell it to the owner of the call option, the purchaser, at the price of, let's say, 110. So this could be that you're paying 200, 300, 400, whatever the stock price goes up, right? So you could make a theoretical infinite loss. What we're doing here with the Iron Condor is we're limiting that infinite loss by also buying a call strike option here. And by longing that, it means that, well, we can at least get in here and buy it for 115. Sure, we have to sell it for 110, but we can get in at 115 no matter where the price goes up. So we're limiting to that point. So if the price goes to 120, 130, 200, 500, 1,000, we can still buy it at around 115 and therefore sell it at 110. So we're only losing that 5, etc. So we're not seeing too much of a loss in that case. But we're hoping ideally that we're able to just earn differential between selling and longing. The further we are, again, if we're around 100, let's say, at the current price, the further out you are away from the current price, the more out of the money you're going to be. So the premium you're going to pay for that will generally be lower than the premium that you earn for selling the strike. So you do make a profit in the intermediate point, just that gap between those two. But you also are going to see earning on the other side. So down here on the left, we're looking at the puts. We're going to short close to being in the money here. We're going to short, let's say, at 90, and we're going to long at around about 85. So by shorting at 90, it means that, look, if the price falls much below 90, we could be assigned. So we may have to actually purchase for 90 the stock, and the stock price could keep falling and falling and falling. So as the stock price falls, now we own the stock, so we're actually losing money, but at least we can get out. We have the purchase, the second option here, the second put option, and so we can get out at around 85. So yeah, we've paid 90, but we can get out at 85. We're limiting our downside risk here. We're limiting our downside risk in the case that the price goes up over here. So we're limited our risk, which is extremely good. Now we're also looking at limiting the period here. This is the kind of the range through which we do make quite a bit of profit, right? So around about 87, 88, let's say, and around about 112. In that range, we're basically making profit. So the net that we earn from selling both the put and the call at closer strike prices to the current price, again, all at the same expiration date, and the further out the strike price that we're buying, let's say for the put and for the call, they're usually a little bit cheaper to buy these because they're further out away from the current price. So it's cheaper to buy these options further out, and we get a little bit more premium from selling these options in between here. As a result, we're going to profit that difference, right? The earning on the two options we've sold, net of the cost of the two options we've bought, but we're really locking in. It looks like a condor, it looks like a bird, right? Think about flapping its wings on the right and on the left, and it's in between. So this is the Iron Condor strategy. We can really see here how we're profiting if the stock stays within a certain range, let's say around 88 and 112. And the closer to that range and the closer that it doesn't really touch those ends means the better we do. As long as it doesn't really go much below that, we're all good. And even if it goes to, let's say, 85, 86, it probably won't be assigned. And as it goes up to like 108, 109, it probably won't be assigned either. So we can push temporarily down to these other limits, but we do see that nice profit if the stock stays within a certain range. So this is a great strategy for sideways motion. We don't think the market is going to go too far in different directions or a low volatility markets. So I hope you've enjoyed this video on intermediate strategies for option trading. And if you did, it only takes a second and it's totally free. Just click on that like button. And if you're not already a subscriber, this would be a great time to click on that subscribe notification bell button. I'll be watching you until the next time.